Welcome back, my awesome people. In today's episode, I will be highlighting the 5 different types of ETFs that are available out there for you to buy and what the differences are between each one so you can maximize your gains. An exchange traded fund, or an ETF for short, is a type of stock that tracks an index, sector, commodity, or other asset that can be purchased or sold on a stock exchange, the same as a regular stock. An ETF is a type of fund that holds multiple assets rather than only one, like a stock. Because there are multiple assets within an ETF, they can be a popular choice for diversification. An ETF can own hundreds or thousands of stocks across various industries, or it could be isolated to one particular industry or sector. Some funds focus only on US offerings, while others have a global outlook. For example, bank-focused ETFs would contain stocks of various banks across the industry, and the SPDR 500 ETF, ticker symbol SPY, which tracks the S&P 500 index. And the main reason for investors to buy ETFs is because of the diversification that it provides. So what are the different types of ETFs that are out there, and which one is right for you? Well, first, get bullish on that subscribe button for the YouTube algorithm and smash all the likes, bells, and whistles to help the channel grow and to get all my updates on my fantastic investments. And comment below with what you think. I do reply to every comment. And if you are watching this video and do not have a Wealthsimple Trade account and you want free money to trade with and $0 commission fees that won't eat into your profits, look at all those perks. Sign up with my Wealthsimple link down in the description box below for $25 of free real money to trade with. Link below. So let's begin. So what are the different types of ETFs out there, and which one is right for you? Well, there are a variety of ETFs out there that focus on a variety of sectors and industries, but choosing the right ETF that will fit your investing plan will require you to do some due diligence, as everyone's investing plan is different. But after watching this episode, I am sure that you will be able to make a choice on which ETF fits your plan. Now, the first ETF is the index ETFs. This ETF tracks major market index and attempts to emulate the returns such as SPY and QQQ. Index ETFs can be bought and sold throughout the day on a major exchange like a share of stock. With an index ETF, investors gain exposure to numerous securities in a single transaction. Index ETFs can cover US and foreign markets, specific sectors, or different asset classes. Like other exchange traded products, index ETFs offer instant diversification in a tax efficient and cost effective investment. The second ETF is the sector ETFs, which is an ETF that exposes you to market sectors without shares in multiple companies. And these ETFs can include XLF, XLE, and XLI. A sector ETF invests in the stocks and securities of a specific industry or sector typically identified in the fund title. For instance, a sector ETF may trade a benchmark index for energy stocks or for technology stocks and can be used to invest in an entire industry without having to piece together the individual stocks in that sector. Sector ETFs have become popular among investors and can be used for hedging and speculating. Third is commodity ETFs, which exposes you to physical purchases of it, such as gold and silver, through ETFs such as GLD and SLV. A commodity ETF is an ETF that is invested in physical commodities such as agricultural goods, natural resources, and precious metals. Commodity Commodity ETFs are popular because they offer investors exposure to commodities without having to learn how to purchase futures or other types of derivative products. When an investor purchases a commodity ETF, they normally do not own the physical asset, but instead own a set of contracts backed by the commodity. So it pays to research commodity ETFs, researching the overall concept in great detail and watching the commodity ETF for a while to see how it progresses as the market changes. Now, the fourth ETFs are the inverse ETFs, which focus on shorting indexes and asset ETFs. And these ETFs include SH, SQQQ, and SDOW. An inverse ETF is constructed by using various derivatives to profit from a decline in the value of an underlying benchmark. Investing in inverse ETFs is similar to holding short positions, which involve borrowing securities and selling them with the hopes of buying them back at a lower price. An inverse ETF is also known as a short ETF or a bear ETF. Inverse ETFs are not long-term investments since the derivative contracts are bought and sold daily by the fund's manager. As a result, there is no way to guarantee that the inverse ETF will match the long-term performance of the index or stock it is tracking. But an advantage of inverse ETFs is that they do not require the investor to hold a margin account, as would be the case for an investor looking to enter into short positions. The goal is to buy the asset back at a lower price and unwind the trade by returning the shares to the margin lender. Conversely, inverse ETFs often have expense ratios of less than 2% and can be purchased by anyone with a brokerage account. Despite the expense ratios, it is still easier and less costly for an investor to take position in an inverse ETF than it is to sell stocks short. There are several inverse ETFs that can be used to profit from declines in broad market indexes such as the Russell 2000 or the Nasdaq 100. Also, there are inverse ETFs that focus on specific sectors such as financials, energy, or consumer staples. Inverse ETFs are short-term trading instruments that must be timed perfectly for investors to make money. There is a significant risk of losses if investors allocate too much money to inverse ETFs and time their entries and exits poorly. And finally, the leveraged ETF. A leveraged ETF amplifies the returns of an underlying index. While a traditional ETF tracks stocks in its underlying index on a 1-to-1 basis, a leveraged ETF may aim for a 2-to-1 or 3-to-1 ratio. In other words, 2 times or even 3 times the gains and losses. For example, ETFs that track the S&P 500 index will contain the 500 stocks in the S&P. If the S&P moves 1%, the ETF will also move by 1%. But in a leveraged ETF that tracks the S&P might use financial products and debt that magnify each 1% gain in the S&P to a 2% or a 3% gain. However, leverage can work in the opposite direction as well and lead to losses for investors. If the underlying index falls by 1%, the loss is magnified. Leveraged ETFs are typically used by traders who wish to speculate on an index or to take advantage of an index's short-term momentum. Due to the high-risk, high-cost structure of leveraged ETFs, they are rarely used as long-term investments. An example of a leveraged ETF includes the Direction Daily Financial Bull 3X shares, ticker symbol FAS, and it holds equities of large U.S. financial companies by tracking the Russell 1000 Financial Services Index, and its top holdings include Berkshire Hathaway, Visa, JP Morgan. And this ETF aims to provide investors with 3 times the return for the financial stocks that it tracks. Leverage is a double-edged sword, meaning it can lead to significant gains, but it can also lead to significant losses. Investors should be aware of the risk to leveraged ETFs, since the risk of losses is far higher than those from traditional investments. So to summarize, Investors who are not familiar with the details and intricacies of the financial markets might be well served by investing in an exchange-traded fund or an ETF that tracks the broader market. Sector funds enable investors to take bullish or bearish positions in specific sectors, while inverse ETFs and leverage ETFs make it possible to incorporate advanced portfolio strategies. Some other characteristics of ETFs that make them ideal investment vehicles for investors include diversification, liquidity, low fees, investment management choice, and innovation. When deciding whether to pick stocks or select an ETF, look at the risk and the potential return that can be achieved. Stock picking offers an advantage over ETFs when there is wide returns, and with stock picking, you have the ability to gain an advantage using your knowledge of the industry or the stock. ETFs offer advantages over stocks in two situations. First, when the return from stocks in the sector has narrow returns, an ETF might be your best choice. Second, if you are unable to gain an advantage through knowledge of the company, an ETF is your best choice. Whether you are picking a stock or an ETF, you need to stay up to date on the sector or the stock in order to understand the momentum. You don't want to see all of your good work go to waste as time passes. And again, if you are watching this video and do not have a Wealthsimple trade account and you want free money to trade with $0 commission fees that won't eat into your profits, still, look at all those perks. Sign up with my Wealthsimple link down in the description box for $25 of free real money to trade with. Link is below. So again, I am not a financial advisor, so make sure you do your own research and consult your own financial professional. Thanks. There is so much wealth out there for all of us to get a piece of. So by allowing our hard-earned money make us more money is the key to wealth and the key to financial success. Subscribe, like, and share to help with the channel, and so you will get notified of when I post my next Wealthsimple Challenge update, my penny stocks, REITs, dividends, and speculative stocks, and penny stock, and any other investments that I am buying or selling. I want everyone to have the opportunity to get out of this work-life trap by buying back their freedom through investing. So let's all ride 2021 together on a journey of health, love, success. So until the next video, stay ranting.